Hello and welcome to XM.com. You're watching today's Daily Market Comment by Haralambos Pisuros. I'm Christina Marujos. The US dollar continued flexing its muscles, outperforming almost all the other major currencies yesterday and accelerating its advance today. What encouraged dollar traders to add to their long positions may have been another round of data releases supporting more hikes by the Fed and hawkish remarks by a couple of policymakers themselves. Getting the ball rolling with the data, both the headline and core PPI rates for January declined by less than expected. Accelerating producer prices could translate into higher consumer prices in the months to come, and thus, combined with the unexpected slide in the initial jobless claims for last week, the data comes to add more credence to the view that the Fed may eventually need to take interest rates higher than previously expected, and that no cuts would be needed this year after all. Fed speakers seem to agree with the market's interpretation of the data. Yesterday, Cleveland President Loretta Mester seemed concerned about too high inflation and noted that interest rates should have been raised more at the last meeting, with St. Louis President James Bullard agreeing in a separate speech that the Fed should have been more aggressive with its recent decision. Should more members become vocal about a higher peak in interest rates, investors could see the median projection for 2023 being revised up in March. Today, Richmond President Thomas Barkin and Governor Bauman will step onto the rostrum, and investors may be eager to listen to their views. Currently, investors are pricing in a terminal rate of almost 5.3%, so more data or Fed comments adding to that view might keep the dollar under buying interest. However, it is too early to envision a full-scale bullish reversal, as ahead of the March FOMC gathering, investors will have to evaluate employment and inflation data for the month of February. Each of Wall Street's main indices finished Thursday's session down more than 1%, with a more rate-sensitive Nasdaq sliding nearly 2%. It seems that data pointing to higher inflation have eventually dented investors' risk appetite, even if numbers relating to economic growth are pointing to a potential soft landing. This comes to add credence to the view that despite the optimism surrounding China's reopening and the evidence that major economies like the Eurozone may have avoided a recession, it is hard to envision indices headed to new record highs. Higher interest rates mean higher borrowing costs for companies, as well as lower present values for firms that are valued by discounting expected cash flows. Thank you for watching today's Daily Market Comment at XM.com. Have a great weekend.